Good evening, everybody. Happy Father's Day. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. This video continues my advocacy for using closed-end funds in your portfolio. And if you want the full strategy, if you want the full methodology to what we're up to, you can check out my Facebook page called Navigate Your Finances. And I talk about our 12 steps to financial freedom and give you the entire framework for free. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company. And sometimes I walk alone. Like I just stuttered on the video. It's a raw, unedited video, so you get to see all my mistakes. Uh, if you've heard these videos before, I've kind of changed up my intro. Um, and I've gone through and significantly updated this with the happenings of last week and really everything in between. So Kiyosaki says he's great at breaking down macro data like world data into micro data, which would be data applicable to you and me. And that's somewhat true, though he doesn't always break down the data into our microcosm data. But that's one of my strengths. I synthesize data. I read a ton. I listen to a lot. I listen to the super macro guys, the macro guys, the sub macro guys like Kiyosaki, and then I condense all of that down into data and into the data that helps our microcosms and our financial worlds and helps guide our strategies. So every video I talk about closed-end funds, and I mean that's been my jam since the start. So why do I like him so much? I'll quote Michael Foster, who's part of the Contrarian Outlook team. He says, "We love closed-end funds chiefly because of their large income streams, which currently average 8.3. That amounts to 690 a month, which he said 680, but it's actually 690 a month for every $100,000 invested. Meaning, if you invest 100,000, then you multiply that by 0.083, 8.3%. You get a number, then you divide that by 12, you get $690 a month, which is incredible when you realize the stock market gives you just a bit over $100 a month for the same amount. But nowadays, still Michael Foster, we're especially focused on closed-end funds' outsized discounts to their net asset value. Just means that you can buy them for cheaper than what they're actually worth. So across the board, closed-end funds are now at an average of 6.7% discount. But that's largely skewed because you can pay a premium for some funds. Like you can pay $1.90 for you can pay 90% more for some funds, and right now you can buy a fund for 50% off. But what most people don't realize about that 6.7% average discount is it results in a yield on the net asset value of almost 8%, right? Or what the management needs to earn in order to get us to that 8.3% payout. So who doesn't like a discount? Like this is me. Who doesn't like a discount? Like if you go to the store, pick a store. Who doesn't like a discount? Now, maybe not Star Furniture because they tend to raise their prices when it's discount weekends. But in general, who doesn't like a discount? Do you want to pay full price and get a crappy dividend like the regular stock market, or say outside of the closed-end fund world? Or do you want to get a discount and get an amazing dividend like a closed-end fund? And I want the amazing dividend and the growth upside. Like sign me up, please. So as we take that overall idea and then kind of craft our strategy out of it, not much change. Excuse me. It's strange. My allergies go like this, and for whatever reason, they tend to spike in the evening. So, not much has changed in the overall market, except that more people are waking up to the following realities. The Fed is lying about the economy, or at least their view of the economy. You and I know the inflation rate is off. I mean, the Labor Department and the Fed both say it's normalizing and leveling, but it's still creeping higher. So ask yourself this. if inflation is under control and that annualized inflation data is lowering, why are we seeing slight increases? You and I both know the data presented is off because our grocery bills haven't seen any drops. I mean, our grocery bills are, 30% higher than what they used to be, 25% higher than what they used to be. That doesn't correlate to 3.5% inflation. So since our grocery bills haven't changed and our fast food eat outs and our coffee and your shoes and your clothes, those numbers have not lessened, right? So if the Fed's doing what it can to control the market and inflation is only going up incrementally, creeping up, I mean, why would it do that? The easiest answers are that Fed or that the Fed is printing money again, and they are, and that they're lying about the overall health of the economy, and they are, or that they're just inventing the numbers, which I think they are. So more people are realizing that we're either in a recession or we're damn near close to being in a recession. Kiyosaki recently predicted a Great Depression type event for the U.S. because more countries are dumping the U.S. dollar as their standard of currency. Seeking Alpha is advising a not a complete retreat from U.S. investment, but more overseas investment because they think the U.S. dollar is going to drop in value over the next several years. Brett Owens is predicting a major fear moment at some point this year. Jamie Dimon, Warren Buffett are becoming increasingly cautious and are amassing cash on their company's balance sheets instead of reinvesting all of that money. And all of that says that they see more risk, or at least an increasing risk of something like that happening. I read a recent brief or a recent interview with Harry Dent, who's a well-known economist in those circles. I mean, the article said he was a well-known economist. I've never heard of him, but I've only been doing this 3 years. So Harry Dent says that's not to downplay my knowledge. It's just in all my reading, uh, books, online, etc. I've never heard of the guy, but supposedly he's well known. So Harry Dent says there'll be some type of massive crash in the first few months of 2025. Basically, he's claiming that with the Fed tinkering with the economy and the markets for the last 14, 15 years, we're going to see a crash. And the bubble can only get so big before it pops. Like that whole idea that, yes, eventually the bubble you blow will pop. So the bubble we're seeing in tech is kind of the same idea. I mean, the Fed's printing money, people are investing in the money, and if you've seen the if you saw the Ready News article or the graphic I displayed last week that shows where people are investing, or say primarily investing the last year, the vast majority of people are buying tech like Nvidia, and Nvidia's pricing is incredibly overinflated. So if I can list the article, I'll give it to you. I mean, I have the article, I have the link. I just don't know if I can post it for the video. Um, but for that article, you've got to see some overall perspective. Like it's very easy to see the here and now, but it's that the Fed's been tinkering with the market through their quantitative easing and quantitative tightening for years, not just the last 15 years. They had stimuluses here and there, plus their recent incredibly rapid rate hikes, and that stemmed from their intentionally caused massive inflation because they printed 40% of currency, like about $4 trillion in a really short amount of time. So if things keep going as they are with the current mindsets in DC and the Fed printing more and more money and manipulating the economy, then yeah, Dent's prediction's possible. But if things were to change in DC, which they just might this November, then our slowing economy And the irresponsible and intentionally manipulating Fed, in my opinion, get a positive electrical charge. I mean, uh, Trump might see, Trump might still see the stock market drop based on the Fed's mishandling of things, but he'll have a counter to it because he's a business guy and he gets that because the current admin and current uh, non-leadership team we have has no understanding of the market and no leadership. And the current mindset has no brain power or intelligence when it comes to the macro market or the micro market or the short and long term outcomes, unless it relates to their personal pocketbooks. They don't care about you and me. And if things are really heading toward that cliff, right? My advice is we pay attention to a lot of different things, but we really look for those smaller independent news articles saying that congressionals are pulling money from the market. I'll say this later. I mean, insider trading doesn't happen, but at the same time, insider trading happens. So where does it leave us? What's the best advice? First, don't let the current market get you down. There's always a doom and gloom viewpoint. There's always a doom and gloom viewpoint, whether it's great or not. Listen to it, read it, understand it, consider it, and then think how it could impact you in the short and long term. Second, we're playing the long game, right? We listen to the short term, we interact in the short term, but we play for long term. Brett Owens recently took my Uncle Art's advice of the market always looks forward and expounded upon it and said the market looks forward like a stumbling toddler. And I'll tack on a little more. The market always looks forward like a stumbling toddler. It makes progress toward the toy, but it's also going to stumble, fall flat, and cry at times along the way. And all I'm saying is that we should buy the best deals now, which is why I like closed-end funds because you can get them at discount. So we buy the best deals now with the long-term game in mind. And even when the long-term game includes the possible doom and gloom. I think we take Kiyosaki's advice: buy what the Fed can't print, and buy what the Fed can't mess up directly. They can still impact costs. They can still impact those other things, but buy what they can't print. They print money, right? They cannot print oil, tech, which is an oil derivative, real estate, and bonds. I think we listen to Brett Owens, Brett Owens talks about the entire market space. I like that, right? He talks about ETFs and stocks and bonds and CEFs and treasuries and all the stuff. But since I only invest in closed-end funds, I just extrapolate his data points on everything else and apply those to the CEF world. And sometimes he talks about closed-end funds. And sometimes we'll say, so when he talks about closed-end funds, he talks about funds that are beyond my price points. He talks about funds that are in premium territory. And I get it. They're a great deal compared to where they normally are, but our strategy is to never pay premium. So if something is 1% more than it's what it's worth, meaning you would pay 1.01 for it, that's not far from break even at a dollar or no discount. But whether it's 1% over or 50% over, we're not going to pay a premium. That's the strategy. We want the discount. So back to Brett Owens. What's he advising? Bonds, particularly closed-end fund bonds and municipal bonds. But why? Well, the Fed's printing again, as opposed to quietly printing. So, say like every real estate article I read, but also um, like our um, like the people on our board, like the people who sit at our table. If you can make money in a high rate market, you will crush it in a low rate market. And that's bonds and real estate and the rest. So if you can make money now in a high rate market, you will crush it in a lower rate market. So think about this. What areas of the market would do best with a rate cut? All of them, right? But which are poised to improve the greatest? And it's bonds. So when rates go down, bond prices go up. When real estate drop, when the cost or the interest rates of real estate, mortgage rates drop, even if they drop by 0.04%, like it, or 0.05%, right? So if you're paying, excuse me, if you're financing money at 7% and suddenly the overall rate drops to 6.95, that's not enough for me to be like, yes, that sounds like a great deal, but there are a ton of people out there, and not to say they're not smart. That's not my point at all. But everybody likes the discount. So if rates have been sitting at 7% and you've been hesitant to buy a house and suddenly they drop and you don't know when the next time they're going to drop happens, people will take that really small percent off and be like, I'll take that while I can get it. And they'll get a mortgage. And the increase in the demand of mortgages has gone up, even though the overall rate hasn't gone down that much, which is crazy. But everybody likes a discount. So when rates go down, bond prices go up. So bonds are set to crush it whenever rates go down. And in the long run, like whether short or long run, uh, so long as rates stay higher for longer, bond prices are still going to do well. So kind of off track and but still on track. So we don't let the current market space get us down. We play the long game. We take Robert Kiyosaki's advice. We listen to Brett Owens, and we look at the CNN Fear and Greed Index, which I think has been off lately, but we still look at the CNN Fear and Greed Index, and we buy in fear and we buy in extreme fear because you get a better deal. When new money hits the market in greed, they're generally buying late. And when you get that fear moment, new money leaves the market faster than the rest of everybody else because they don't want their overall principal to go down. And then that fuels the fear, and then prices drop more. So when prices drop into fear territory, you're getting a decent deal. And if you buy in extreme fear territory, you're getting a great deal. And if you're buying in neutral territory, demand a steep discount. And if you're buying in greed, I would still demand a steep discount. And if you're buying in extreme greed, I would be cautious. You do you. But it's not my goal to buy an extreme greed. Um, and the goal is the buy the best discount you can buy at all times, but it's gauging that metric on when you should invest in general, right? I mean, we're always looking to optimize the buys with steep discounts, and we're not, it's not that we don't want to invest, like we want to invest, but we want a good deal. So it, from my standpoint, if the ticker ever hits extreme greed, as much as you might want to buy along with the rest, don't be afraid to sit on money and wait for the fear opportunities. But at the same time, like if the ticker's in extreme greed and the herd is following one specific track, don't be afraid to go somewhere else and get an amazing deal on something that's been cast to the side. And even though the overall ticker is in extreme greed and you're buying in extreme greed, you're buying something else that's not in that extreme greed category. There we go. So besides the index, we look at the overall cost of oil. And when oil is in the 70-75 range, that's a great deal. Currently, it's close to that at 78. You can also get oil through a pipeline transfer company. Those tend to target oil and liquid natural gas. So just like Crown Castle or American Tower is a toll bridge operator for connecting cell service companies with data management or towers and broadcasting ability. Energy transfer companies become the toll bridges for getting oil from one place to another. You can look at the overall liquid natural gas or the LNG curve, and when that's close to $2, which is pretty much the floor of LNG, that's a great deal. Um, of what I've read lately, there are a ton of AI companies looking to cool all their server banks, and a lot of them have done that with water in the past, but the cost of utilities is going up. And with the US in a current surge or surplus of natural gas, a lot of companies are looking to kind of harness that really cheap resource at the moment and use that to cool their servers. Uh, with our strategic reserve at about half, energy seems to be a little bullish. You just kind of have to find the best discounts. From what I'm seeing, oil is still surging, much like technology is still surging. But if you find it at discount, then that's great. I think junk bonds are junk investments, at least for us. Maybe if you got better access through a giant company, maybe that's a better deal. But for us, they're junk. True consumer goods like ketchup, mustard, and Oreos are too chaotic for me. Factor in a global fund, and that's way too chaotic for me. Like a global consumer fund is not my cup of tea. A global bond fund, maybe. Um, a recent Seeking Alpha article I read for free because I don't pay for their service had a great quote buried in the article. Higher for longer interest rates present opportunities for fixed income investors, bonds, credit funds, treasuries. Um, and then, per Michael Foster of the Contrarian Outlook again, stocks might actually go up because the labor market is stronger than what's being reported. Now, I don't know if that's enough for me to jump on the stock bandwagon, but it's interesting. So, knowing all of that stuff, where do we look? Well, where's the herd? The herd is in technology. Where's the bubble? Mostly in technology. What's helping the bubble? That Fed money. So, wherever we go, we should go where the herd isn't. So, our focus right now is bonds. Loans and real estate is like a bond proxy. They're downwind, they flow in a similar current. Oil, it's the backbone of everything. And it's the direct backbone of energy infrastructure, and tech. That's surging. All right. But we're not really targeting it. So if we find it in a portfolio that has it, that's great. But we're not targeting oil. We're not targeting energy or utilities. Kind of kudos if you can find it through a bond. Uh, yeah, same thing with tech. Like we own a tech, we own a direct connection, direct investment in tech, but we're not spotlighting it at the moment. We're not seeking it at the moment because of how big the bubble's gotten. Um, and maybe it'll only grow. Like maybe it'll just kind of keep pumping in, and at some point it'll pop way down the road. But I don't know. So we'll ride this one and see. I'm not fearful of it popping. I'm more aware that it's going to pop sooner than later. So if that means that it slides, like everything slid at COVID, right? Or it slides for whatever reason, or pops, however you want to say, however it looks on a dot map or on a plot map, then we would sell it, let it drop out, and then pick it back up when it's super cheap. Um, so I've spun enough for now. So let's see where the bargains are. And right, maybe I've talked enough for now, at least on all the background data. So let's see where the bargains are and see what we can do in the short term that'll help us in the long term, or best help us in the long term. That's probably a better way to say it. So I'll get to the color codes. First and foremost, the asterisks and the overall rule: don't pay premium. So the triple asterisks are a buy alert, meaning the existing discount for that fund is at least double the historical discount and greater than the 5-year discount, or it's a really young fund and the discount is still significant. Some like the funds that are less than a year old, I've got their 1-year discount, uh, and I mean one in particular. So look at this one. And the 1-year discount's 23. It's a brand new fund. The discount has been shrinking like crazy. So I get that 9.5 is definitely not, half or even close to 23.5, but it's still significant just because it's really new. Two is a dollar cost average. I mean, they're not going to make the transfer list. Dollar cost average based on what we already have. Um, and then one is we're tracking for any number of reasons. The color coded system, dark blue we own inside our Roth account, light blue we own inside our individual brokerage account, green I'm tracking, or olive I'm tracking for any number of reasons. Purple is generally recommended by somebody I trust. And I say generally, I mean they're all recommended by someone I trust, but at the same time, I've been working to clean them out to make them current. But occasionally I still find something that's not current. So what I do is I update the list every week. I update the entire list of closed-end funds once a month, and then I update the color coded. So I update light blue, medium blue, purple, olive, not gray. But I update one, two, three, four, these four colors uh, weekly, and then I'll go back through and rescreen the targets based upon the current data. So every triple asterisk gets dropped into a new spreadsheet. That is not every triple asterisk. Gotta love that. That's what you get for raw video. There we go. What we're targeting is already over here. And the reason why it's off is because of this column. And then we're going to end up putting this at the bottom. Otherwise, it'll get cut off as we adjust. Maybe it'll still get cut off. These spreadsheets do different things every week. So all of these are significant discounts. So I filter the list more. First and foremost, we want monthly dividends. We want consistent monthly dividends. All of them are significant. So now we want ideally, we want a 9% plus yield, which sounds crazy if you're not used to closed-end funds. Uh, the two, I'm going to advocate for two. Normally, I advocate for one, and we're picking stocks for the Roth, or I guess we're picking funds for the Roth. I could argue, so I'm going to advocate for three. So if we were adding funds to the individual brokerage, you can buy municipal funds that aren't taxed. So you get a tax equivalent dividend. I mean, if you were paying a tax, that would be the dividend. But since you're not paying a tax, you're getting a different dividend. Um, and if we were buying funds for the individual account, decreasing our overall taxes and optimizing our dividends sounds amazing. But we're not buying funds for the individual account. We're buying funds for the Roth. And the Roth, so long as we jump through all the hoops, we don't pay any taxes on. So it's kind of a moot point. Like it's not helping us in the Roth, but it would help us in the individual. But we're not adding funds to the individual. But if you're adding funds to your individual account, they're worth your consideration. This remains the greatest discount, and I don't get it. I mean I've updated my sector information. HFRO manages a ton of money, and it's all real estate. The information on Closed End Fund Connect or CF Connect and Morningstar isn't accurate. I had to go dig through a recent quarterly shareholder update in order to get the breakdowns of their current portfolio. It's all real estate, or it's at least all real estate related. Um, And it's the greatest discount. So if we were, and I haven't, excuse me, so if we rank it by discount, I don't know if there's a break-even fund this week or not. There's two. Look at that. So if you invested in either of these funds and we used the dollar as break even, every dollar that you invested into these two funds, you would invest a dollar. If you bought at premium, like if you bought this fund at 58% premium, you're paying $1.58 for every dollar invested. And if you buy the discount at 52% off, you're paying 48 cents for every dollar invested. So you're getting a fantastic deal. And if you want to buy premium, you can. And if you want to buy premium, you can. But that's not my jam. So that's the steepest discount. And I get that it doesn't pay 9%. They cut their dividend when they restructured, and I still don't know the whole story, but they restructured bonds to real estate and they cut their dividend in half. That was their dividend before the restructure. Currently in real estate, not all of their real estate projects are online. They've got projects in the works, some that will come to fruition in the next 1, 2, or 5 years. It's an interesting thing. So if they can pay out this in this high interest rate market and that not all of their projects are online or not all of their projects are up and running and finished, then my hope is that their dividend comes back. But currently, it's the best dividend or it's the best discount. So you got to leave it on the list. The other one I can advocate for is this one. I get that it has this discount, or sorry, I get that that's the dividend and it's not 9%. They have a history of paying hidden yields, and the last one they paid was in 22. I mean, they didn't pay one in 2023, higher rates. It does not come into discount territory for long. That's what I have pulled up here. Um, so if you look at the overall uh, map or overall graph, and it gets a little blurry. Uh, we want this one. So when the price is below the net asset value, so when the dark line is below the blue line, you're getting a discount. But that dark line doesn't hit below the light blue line that often. And that's mirrored in this graph. You, I mean, it's historically premium. The average the last 5 years is premium. So when it hits discount, even though it doesn't look like that big of a discount, when it hits discount, it's noteworthy. And if you put it in a lower interest rate market, you have the potential to see these hidden dividends return. And what that looks like, and I know this because I've looked at this so much, this would change the formula. So that's the standard dividend plus the most recent hidden dividend or that extra dividend times however many shares you have. And now you get that. And that matters. We want to do the formula that way so that regardless of what number you type in here, yes, that's going to change, but it's not going to change the yield. So the yield stays the same, whether it's 1 or whatever you put in there. But since they haven't paid that dividend in 2023, that's the dividend right now. Or that's the dividend and the yield right now. So moving on. So if we cut out the other sub nines, and there's some great funds inside the sub in the inside the sub nines. I can advocate for some. But if we're really targeting bonds and real estate and loans, then they don't fit the bill. Oh, we're still there. All right. So we can delete the column. Now we have that come back. If you want to see it on the screen, we can do that. So now we're left with these. So we're still deleting. So this is right. This is all stocks. I get Michael Foster's data, but I get his data points, but I'm hesitant. Uh, Saba in all government. Oddly enough, ECT. Yep. Right. We can buy government access here. We can also buy government access here. We're already invested in this one. This one just went through a stock split. So I'll drop that one off the list. I get their impact. This one's a temporary fund. You're essentially buying it today, hoping that by the time it liquidates, your net asset value is higher than this. Uh, and then whatever your net asset value is what it'll liquidate as. So currently it's about a $3 difference. Uh, Maybe it would be that way, maybe not. I don't know. But oddly enough, the more I think about this, I still can't convince myself to do it. All of this renewable energy is dependent upon oil, but they're not invested in oil. So it doesn't make sense to me. Uh, all stocks, all stocks, all stocks. This one, I mean, we're invested here doubly in the individual brokerage and in the Roth. But it's higher. It's almost $3 higher than where we bought it in the individual, and at $1.50 higher than where we bought it in the Roth. Um, it goes back to the stocks. It's all stocks. That's a super small bond company, but interesting. Yeah, they have a single bond in their portfolio. I honestly don't know why I haven't put bonds or stocks on this, but I do know that it doesn't make my list. This one is bonds, but as I thought about all of this today and yesterday and kind of thought about where it's like you kind of think about where you project, I guess you would go, but you don't want to bias your data. It was like, that sounds like a really good deal, but it's more of the same of what we already have. And it's diversification that I just don't need. I mean, yes, it pays a great yield. It's monthly. It's sub 15. It's a younger fund, so it's that one. It's got a great discount, but honestly, I can get the same thing in a different fund that we already own, and I like what BRW is doing. I mean, BRW is challenging BlackRock and making waves because they're challenging some of these older closed-end fund companies and challenging the narrative that they pay their managers too much, that they have shirked shareholders on both dividends and overall value. And instead of just complaining about it, they're actively pursuing a way to fix it to the point where they've bought majority shares in certain companies and are working to install or replace current board members and forcing those companies to change their ways. And BlackRock's response was they changed their dividends. Um, I found out they've got a majority share in a gold fund or in a minerals fund and replace some people on the board. And even if they don't do anything else, they're actively pursuing a better environment for shareholders, which I like because not many people can challenge BlackRock. So when you're forcing BlackRock to make changes in their billions of assets, if you're when you're forcing them to make changes or lose board positions on their own companies, that says something. And me personally, I want to invest in that. So BRW stays on the list as opposed to the other. So then it comes down to four funds of what we already own, a super small bond fund, which is just it's interesting. Like Morningstar doesn't have the data. CEF Connect has limited data. I had to go to their website to get more data. Um, I mean, they are stacked in fixed income. So is FCO. So, and then the other that I can advocate for is this one. So, kind of like where would we invest? I mean, I could advocate for a 50 share in all of them, um, and not really target anything. But um, since I like certain companies and what they're up to, the Highland brothers are, well, let's go back. So this is where we stand currently. Don't own the olive ones. So in a perfect world, that minus the sum of these things. So it's important that this column is different than this column. This column is what it does cost a share. So if I update this column, it'll automatically update this other column. But I wanted this separate column because it's dependent upon how many shares we have or how many shares we're buying. That way I can still see the overall cost a share and what it would be if we bought X number of shares. So take the investment availability, subtract the cost of these cells, and then we get a remaining balance. And we'll put our focuses right there. Which are these? We get bonds, bonds, bonds. Well, that's bonds and more, but 15% bonds, but then you've also got access to these other things. Some of what we're not directly targeting, some things that I'm just not a huge fan of, but then also you get access to some other stuff. Let's see, bonds, fixed income, real estate. And when I say real estate, like if you look on here, it's stocks. I mean, I get that. It's how they're labeled. My closed-end funds on Webull are listed as stocks. But when you look on Morningstar and look at their data, it's real estate. And then you've got a mix, stocks, bonds, and other. But it's all real estate. It's not just the obvious single-family home or multifamily housing, like pick your apartment complex. It's real estate like American Tower. That's cell phone data. If you, what I like about Morningstar is you can see the company info, then you can also see what they do. Industrial logistics, well tower, senior housing, medical offices. Simon Property is the mall. Digital Realty Trust. I've been tracking a while. But you get data center, right? Rentable space, retail stuff, Crown Castle, which does not sound like a cell phone cell tower service, but it is. Extra storage spaces. Like it's not outright real estate how most people think about it. And their bonds represent, yes, like a third of their holdings, I guess you could say. But based on the overall weight of their portfolio, it's not enough to make the list. So it's a pretty interesting fund. Yeah, and then HFRO is just it's real estate. Like it is all real estate. So it's interesting real estate. Like they're converting space in the Dallas area to be a giant office space. It's interesting stuff. So what would I do? I would put my money where my mouth is and invest. Interesting. 71 off. This is what I like doing live because you get to see, I get to explain things, but you also get to see how the system works. You also get to see that I can't buy everything in a perfect world. Um, CIF is interesting. So I can give them the same access as those two guys. Don't think that works. Nope. Or I can do this. I can give them 100 spot for new. Um, this is what we would have left, plus whatever we would gain in dividends, and we'd end up with 500 something. Uh, and then pending on next week, we just look at the best overall investment for that $500. And that could be here, wouldn't eat the whole 500, could be here, would still not eat the whole 500. Could also be another 50. Oh, like that doesn't make sense, but it's a really cheap company. Since we've tracked this company, which I mean, I started this list in 2021. So since we've tracked everything, I mean, the highest the company's gone is like 350, but it consistently hits $3. So as much as I want to build a lasting portfolio that just earns, like I can add to it, but I don't have to worry about watching it to know when to sell it. This might be one of those cyclical funds. Let it hit that $3 mark, sell it, right? Invest in whatever, let it drop to crazy discount territory again, which price it's the crazy price point and the crazy discount because same thing. I mean, they don't hit really low discount numbers again, but wait till it hits crazy discount territory or just a real and crazy discount territory and a really low price point again. Buy it low, let it take off, sell it high, buy it low, right? And use that money and the price increase to just kind of fuel the portfolio. And in the Roth, so principal in, you're limited on what you can put in. But principal in, you can take out, no penalty, whatever. That's what my tax guy says. So regardless of what you read online, but the capital gains you see. So if you like that one, say I have, so you buy it low, you sell it high, that money you make, capital gains. So long as the money stays in the portfolio, you don't take it out, you jump through the hoops, and you withdraw it at whatever age, like whatever the hoop says, then you pay no taxes on it. So all the dividends that you would normally pay capital gains taxes off an individual brokerage, or the gains you make selling stocks inside a Roth are not taxed, which is crazy. So it's a really small amount, right? For this one fund, like 1.3. So 1.69 to 3 is 1.31. There's 100, which if you're not great with math in your head, right, is $131. Not a huge amount, right? But now you're using that to then buy something else, kind of carrying your money for, well, all not kind of, but just carrying your money forward, which you're not paying taxes on. And if you're doing it grand scale, like 500 shares would be close to 650, right? And it's the risk reward of things. If you lose the money, you're not paying taxes on it anyway. If you make the money, you get to decide how you uh, strategize long term. Like I would love it to be a set it and forget it, but at the same time, I like the idea of fueling our availability of funds to then buy more stuff. So my take of things, since this one is mixed, like I can advocate for either. I mean, honestly, that's a pretty low price point compared to the rest. 737 there is a little bit. I mean, it's nominally higher. It's a little bit higher than where we bought it at. We could wait and see how it goes and hold off. I mean, you'll notice there's not a ton of a difference between this and that. And with our current monthly dividend at 67 plus whatever we're about to take in, this would cover another 50 spot of this company. So I'll leave it at that. That's what I got for the week. And that's based upon our strategy in highlighting the things that would do best in the short term with the long term in mind, or maybe best with the long term with the short term in mind, however you want to say that. But it's the best for our current market, but it's also just the best thing long term. Um, and if the market changes a little bit, then I will be completely open to changing the strategy. But in the current situation of things, this is where we're looking. And I mean, I think that applies to everybody. I love the oil companies we have and the energy transfer companies we have inside our individual account. And yes, this is all of our individual, like this is our portfolios. I love this company. Um, I love this company. I would love to buy more of them, but discount wise, they don't fit the bill right now. Um, KYN selling for more than what we bought it for, but overall not much more. But based on the current discount, it doesn't meet the metric, and the dividend has dropped a little bit. NML has the dividend, but it doesn't meet the metrics on buying the historic discounts. So as much as I would love to buy more of those companies, it doesn't fit the current market. It would fit the long-term game plan, but it doesn't play the current market well. So it's still do the best you can in the current market with the long-term game plan it plays, and then be open to changing the game plan as needed because the market's going to change. So that's what I got for the week. If you enjoy my content, whether you agree with me or not, I mean, if you don't agree with me, that's fine. If you agree with me, that's great. Uh, but whether you like the content, well, no, whether you agree with me or not, if you like the content, consider subscribing to my channel. Hit the like button because it really does push videos out. So you can also head over to Facebook and join my group there called Navigate Your Finances. And that information will be below. So regardless of where you are on the gambit of investing into the stock market, regardless of your strategy and your system, you are the captain heading that ship. And if you could plot your journey on a map of kind of where you are, whether you're in a pirate ship, I'm in a pirate ship, whether you're in a pirate ship or a dinghy, and you're, or paddle boat, and you're hoping to get across the map to the desert island and beyond, you're the captain of that ship. Your boat will go wherever the wind sends it if you do nothing. But it sure as hell isn't going to send it where you want it to go. So, captain your ship if you want a chance, if you want the chance of reaching your dreams and your, like, if you want the chance of accomplishing your purpose, like the overall number one reason of why you're doing this, if you want a chance of that, then you're going to have to take the wheel or put your feet on the pedals, right? And actually move your feet. The boat will go wherever you don't steer it still, into the rocks, into the beach, capsized in the waves. It'll still go somewhere. But if you want to go where you want to go, right, and accomplish what you hope to want to do, then you actually got to captain your ship and lead that ship and direct its course and do the work, right? So if you don't know where you are and you don't know where you're going, or if you don't know why you're even on the journey, that those are all important things. I talk about that on Facebook. And if that doesn't make any sense to you, still go to Facebook and check it out. See what you think. I talk in nautical metaphors because it makes sense, or at least it makes sense to me, but it makes sense, right? So if you can figure out where you are, then you figure out where you want to go and you figure out why you want to do the stuff, that's huge. It's huge. It's game changing because the goal is not just to get to the desert island with the X marks the spot. The goal is to survive beyond that and keep going. But it's not going to happen at all if you're not willing to take the wheel or pedal the boat and do something about it. So, regardless of what's on your map, regardless of your dreams and your goals and all the other stuff, it's not going to happen on its own. You got to make it happen. So, captain the boat. So, this is Daniel Young signing off. I will see y'all in another video. Hope you have a great week. Hope you have a great day, and see you again at some point. Bye bye.